Today, we're going to tear down and rebuild one of the most incredible financial disasters in all of history, the South Sea Bubble of 1720. Yeah, it's a 300-year-old story, but it's got everything: ambition, unbelievable greed, and a market crash so huge it literally shaped the world of modern finance. Let's jump right in. So, everything really kicks off with this single question. Just picture it for a second. You're in charge of a country, and you're not just broke. You're facing a debt so massive it could actually sink your entire economy. What on earth do you do? Well, this wasn't some thought experiment for Britain back in the early 1700s. This was their reality. They'd been at war for decades, and the government was buried under a mountain of IOUs to its soldiers, its sailors, its suppliers, you name it. The entire nation was teetering on the edge of a fiscal cliff. And here's just how bad it was. 9 million pounds. That was an absolutely staggering amount of debt back then. To give you some perspective on that, investor confidence was so low that government bonds, the government's promise to pay you back, were trading for about half of what they were supposed to be worth. The market was basically shouting, "We really don't think you guys can pay us back." Okay, so in the face of this absolute crisis, somebody came up with a wild, radical solution. A new kind of financial engine was built, one that was designed to take all this toxic, worthless national debt and somehow, magically, turn it into a national obsession. And that engine was called the South Sea Company. Now, on paper, it looked brilliant. It was this public-private partnership with a genius two-part plan. First, the company would basically eat up all the government's massive debt, and in exchange, it was given what seemed like a priceless treasure: a total monopoly on all trade with the Spanish colonies in South America, which everyone believed were just overflowing with gold and silver. So, how did this whole machine actually work? Well, it was a pretty simple, but you have to admit, brilliant idea: a debt for equity swap. Let's say you were one of those poor souls holding a nearly worthless government bond. The company comes to you with a deal. They say, "Hey, trade us that dodgy piece of paper for these shiny new shares in our company." And the hook, the thing that made it all so tempting, was that those shares were supposedly backed by the promise of unimaginable riches from the South Seas. But here's the thing. There was a fatal flaw baked in from the very beginning. The promise was this fire hose of gold and silver flowing back to Britain from South America. The reality? It was more like a leaky faucet. You see, Spain actually controlled all that territory, and they were not exactly thrilled about this deal. They only allowed Britain to send one single ship per year, and they slapped heavy taxes on even that. The entire business model was basically built on a fantasy. And we have to be really clear about the dark side of all this, the foundation of the supposed value. A huge part of the company's promised profits was something called the Asiento. This was, to put it plainly, a monopoly contract to supply enslaved Africans to the Spanish colonies. So the hype, the excitement, the profits that fueled this whole thing, they were directly tied to the horrific business of the slave trade. Now, despite this incredibly shaky foundation, the plan worked. Actually, it worked a little too well. The stock didn't just climb, it went supernova. It ignited this speculative frenzy that just consumed the entire nation, a time that people would later call the madness of men. The year 1720 really tells the entire story in a nutshell. Look at this. The stock starts the year at a pretty respectable 128 pounds. By the middle of summer, it's peaked at an absolutely unbelievable 950 pounds. And then the bottom just falls out. You can literally see the classic perfect shape of a financial bubble inflating and then violently bursting. So you might be asking, how in the world did the price get so ridiculously high? Well, one word: leverage. The company's own directors created this incredibly dangerous feedback loop. As the stock price went up, they started letting people borrow money against their shares so they could buy even more shares. The company lent out a colossal sum, 11 million pounds, against its own inflated stock, which is like pouring gasoline directly onto a fire. And the mania didn't stop with the South Sea Company. It spread like a virus. A whole ecosystem of these bizarre copycat bubble companies popped up. My personal favorite has to be the promoter, who successfully raised a ton of money for a venture that he described only as an undertaking of great advantage, but nobody to know what it is. People actually gave him money. It's almost funny, but it just goes to show you how completely detached from reality the market had become. And look, this wasn't just some frenzy for the uninformed. Even arguably the greatest mind of the era, Sir Isaac Newton, got completely swept up in it. He invested early, he sold for a nice profit, but then he saw the price keep going up and he couldn't resist. He jumped back in near the very top. He ended up losing a fortune, which led him to say this famous, bitter quote. The point is, if Isaac Newton could get burned this badly, absolutely no one was safe. And of course, anything that goes up that fast is bound to come crashing down. The pop was inevitable, and when it happened, it was absolutely brutal. Almost overnight, the entire country went from euphoria to sheer panic, and everybody started looking for someone, anyone, to blame. Now, ironically, one of the things that triggered the collapse was a law that was actually meant to protect the South Sea Company. At the peak of the mania, they got Parliament to pass the Bubble Act to shut down all those rival companies. But in trying to kill its competition, it ended up popping the entire speculative ecosystem, which in turn pricked the South Sea bubble itself. It's just a classic case of a plan backfiring, spectacularly. The scale of the wipeout was just breathtaking. An 80% drop in the stock's value in just a handful of months. Imagine that. Fortunes that had been built over generations were just gone in a matter of weeks. It was like the financial heart of the country just stopped. So the fallout from this crash, it was about way more than just money. It was a political earthquake, a social cataclysm. It forced a national reckoning. And believe it or not, out of all that wreckage, the foundations of modern finance were actually forged. A parliamentary inquiry basically ripped the lid off the entire scheme. And what they found was just staggering levels of corruption, right at the very top of government. The Chancellor of the Exchequer, that's like the Treasury Secretary, was literally thrown into the Tower of London. The company directors had all their personal assets seized. It was a massive scandal that implicated the entire political elite. But out of all this chaos, one man really rose to the top, Robert Walpole. He'd been against the whole scheme from the very beginning, and now it was his job to clean up the mess. And his skillful crisis management not only saved the country's finances, but it effectively made him Britain's first ever prime minister, a job he would hold for the next 20 years. But the legacy of this bubble is just so paradoxical. On the one hand, the trauma was immense. It created this deep, cultural fear of finance and speculation. New laws were passed banning things like short selling. And that infamous Bubble Act ended up stifling corporate innovation for more than 100 years. It kicked off a long, long period of financial repression. But here is the crazy twist. The scheme, for all of its corruption and all of the chaos it caused, actually worked in one really important way. It consolidated the national debt. And this created a new kind of long-term economic stability. It established a safe, reliable government bond market, which, counterintuitively, freed up capital for riskier ventures, the very ventures that would eventually go on to fuel the Industrial Revolution. And you have to remember, Britain wasn't alone in this. At the exact same time, France was going through its own, even bigger financial bubble, the Mississippi bubble. But here's the difference. When the French bubble popped, it completely destroyed their entire financial system. Britain's system, because it had competing institutions like the Bank of England, proved to be way more resilient. It bent, but it didn't break. And that brings us right back to today. Think about it, a super complex financial innovation designed to solve a government debt problem, supercharged with massive leverage, and hyped up by the state itself, which all leads to a massive speculative mania and then a devastating crash. Does any of that sound familiar? It's a 300-year-old story that's a powerful reminder that the line between financial genius and collective insanity can be terrifyingly thin.